He just stays like what Dodson has. Yeah. Yeah.
You should talk to Sam. I'll introduce.
I'll switch over to you.
What happened to my clicker? I had a clicker. Did you see my clicker by any chance? I had a clicker here. Did I leave it somewhere here? I had it here. I even tested it.
I do it in home.
This
You
one?
put it under.
Yeah, no, but this piece is missing.
What piece?
That goes in here.
That's there, right?
Oh, this. Okay, sorry. Good thinking. Sorry about that.
I don't know if you want a microphone, just in case it's right there.
Yeah, I can. Is the microphone better for this?
Yeah,
For the streaming?
Probably, yeah.
Okay, so I can use the microphone.
Okay.
So. Okay, great.
All right, thanks everyone for coming out tonight. Give it up for Badri with Avestor. He's going to teach us on customizable funds.
Could I bother you guys to come up a little forward? It's easier to have more of a personal interaction. I promise I don't bite. There you go. Can everyone hear me clearly? No? Do I have to pretty much speak into the mic? Yeah. How about this? Better? Okay, great. I like to walk around a little bit, but I think if people are close enough, I mean, that's good. So, all right. Well, thank you all for coming. I think I had a chance to meet many of you. I just really want to keep this very interactive. So, feel free to jump in if you have any questions. And, I always like to learn about the speaker before we proceed too much. My name is Badri Malynur. I'm a co-founder of Avestor. We basically started this company about 4 or 5 years back, and I'll talk a little bit about it. But personally, I've invested in a variety of asset classes. I used to run a hedge fund which involved index trading options, commodities. I've invested in about 35 companies as a startup, a few VC funds. So happy to chat with you about any investing asset class. I've had a couple of startups. Love hiking and skiing. So my wife is with me. She is part of the Avestor team. And so that's a little bit about me. My goal is to visit every country in the world. I'm up to about 75, quite a ways to go. So, all right, let's kind of get started. So raising capital can be very complicated, time-consuming, and costly if done the right way, right? So how many of you have actually raised capital before from other people? Okay. And how many of you have raised capital for your own deals, meaning deals which you source, you're buying the property? Oh, several of you, okay. And how many of you have raised capital for others? For people, deals which you don't control? Okay. So we have a lot of people who basically have raised capital for their own deals. And the most common mechanism for that is creating a syndication. I'm sure Shamir and Chris can talk to you all about that, and you probably have worked with them or other attorneys. So, which is great. I mean, creating a syndication or an SPV is a great way to start. Certainly, you don't want to start a fund or anything right in the very beginning. But the challenge with creating a syndication is it's hard to scale. And the new way of doing things is creating something called a fund of funds. And especially what we have is something called a customizable fund of funds. So the challenge with the syndication is you're paying, I don't want to speak on behalf of Shamir of what they charge, $10,000, $15,000, $20,000 for each BPM. And then you're doing a separate blue sky filing. Who knows what a blue sky filing is? So you're doing a separate blue sky filing, which is a filing you have to do with the state authorities for every single deal. Separate accounting, separate taxes. If you're doing one deal a year or maybe once every couple of years, no problem. But if you're doing 3-4 deals a year, that's not a great way to scale a business. Yeah. If you do, for example, 4 deals a year and you have blue sky filings, you have investors from 10 states, that's 40 blue sky filings. Average of $300 a filing, New York is $1,000. I'll let you do the math, yeah? So what we have built is a platform which completely transforms capital raising. The best way to think about this is think of it like a platform which encompasses everything you need to raise capital for your own deals or for others. There are 3 planks to this platform. There is the technology piece, there is the service piece, and then there is the network piece. I'm going to talk about each one of these elements. It's important that they all collectively work together, yeah? So in terms of the technology, the traditional way, you create offering docs, you onboard the investors, you manage the offering, you do accounting and taxes, and then repeat the process every single time. Many of you have done that and in the past, or at least are somewhat familiar with the process. In the Avestor way, you create the offering docs once, and then you onboard the investors once, and then you can add unlimited number of offerings within minutes to the platform. You can do your own deals or you can raise money for others. Yeah? I'll talk a lot more in detail about how that works. So the second plank, if you will, is the services piece. Do not think of us just as a software platform. Comparing us to just a software platform is like comparing a steering wheel to an automobile. Now, we can have all kinds of academic discussions on my steering wheel is better than yours, mine is thicker than yours, it turns faster than yours. The question is, do you want a car or do you want a steering wheel? We offer you everything which you need to launch, market, and scale your fund. We consult with you on the fund strategy. We do legal and regulatory work with partners like Shamir and Chris. And so we do everything which you require in terms of being compliant for your fund. We help you with the investor management, investment management. We have partners who, we basically include the accounting and bookkeeping for the fund free of cost. And then we have tax partners who do your fund tax return and actually issue the K1. So I'll go into a lot more detail, but everything you need for launching, marketing, and scaling your fund, we help you with, okay? Feel free to jump in here with any questions, yeah? The third plank, I told you, we'll get into, I'm just giving you an overview of all these 3 planks, and then we'll get into more detail in each one of these 3 planks, right? You're also part of, we were kind of talking during the socializing session about various masterminds. We have our own mastermind, which you don't pay additional for. I mean, it's all included in the price of our platform. You network with, we have almost 300 fund managers. We think we'll hit 1,000 by end of next year. You're part of this network. We have dedicated Slack channels for legal compliance questions, marketing questions, CRM questions, strategy questions. And we invite experts. Just last week, we had an expert on the use of video and AI for marketing to your investors, right? I mean, we have all these experts come in and talk about these different topics. We have financial models which tell you how you make money in the fund of funds. Everything you've been doing in syndications, you can do with the fund of funds and more. If you're charging due diligence fee, you're charging a deal origination fee, you're charging acquisition fee, property management fee, everything you can do in regular syndication you can do. And you can also do a variety of other fees. We'll talk about some of the structures. So we give you financial models which help you model your business out. Let's be very clear, a fund of funds is a business. If you want to casually do 1 or 2 deals, then just stick to a syndication, you're done. But if you want to build a scalable business, you have to think of it as a business. So we help you with the modeling the business, we help you with the strategy. And then we have deep down training sessions we'll talk a little more about it. There are two parts to it. We have trained this mastermind sessions every week, but we have two other training sessions. There is a 10-week class from Lance Pedersen. He's launched dozens of funds in his career. We'll talk a little bit about that. It's self-paced. You have office hours with him. And then we also have a 2-day training class in Portland, Oregon, where it's really almost like a franchise model, where we tell you everything you need to launch, market, and scale your fund. And then the last element, I don't want to de-emphasize this. We actually have these sessions where you can present your deal to other fund managers, and they can present their deal to you. And obviously, you have to share a split. I mean, there is no such thing as a free lunch. And not only that, you can negotiate. We negotiate with top-tier sponsors in every asset class: marinas, mobile home parks, retail, hospitality, self-storage, triple-N. You may not know anything about those asset classes, but that's where we come in. We educate you on those asset classes. We introduce you to those operators. And then we collectively negotiate terms with these operators. So what I mean by that is, I don't think I'm a great negotiator, but if I have 300 fund managers behind me, I'll stand on top of their shoulders and say, hey, I can expose you to 300 fund managers. And guess what? Every asset or sponsor is willing to take my call once they know the power of the network. And if it's 1,000 in a year or so, yeah. So what we do is we negotiate collective terms. What do I mean by that? We all know it's like the Costco model, right? I mean, if you raise $5 million, you're going to get different terms than if you raise $200,000 or $300,000 for somebody. Makes sense, right? So what we do is we say that the Avestor community will collectively raise $1, $2, $3, $4 million, and you give us preferred terms for the collective community. So even if somebody comes in and just raises 300,000 and somebody else raises 500,000, you're getting the $1 million, $2 million, $3 million tier. And there have been several cases where we have negotiated a 90-10 split or a 85-15 split, and you can take 15% and pass 70-30 to the investors. So the same fund can be used for your own deals, and it can also be used for deals where you raise capital for others. I want to stress that, yeah? So the way it works, you create one fund for all your deals. You can add unlimited number of deals over time, and then your investors get to pick and choose which deal they want. Think of this like a stock brokerage experience for your investors. I'll give you a demo. I'll actually show you my personal account in a fund we launched to test out the platform. So you'll kind of get a sense for how that whole thing works. Just like a stock brokerage account, do you know every single stock you're going to buy? I don't. And when you open an account, do you really know every single stock you're going to buy? You deposit some money in the account, so you can have a fund level minimum and you can have a deal level minimum. And then with a click of a button, you don't have to sign individual PPMs for each deal. You can invest your money across multiple asset classes, multiple geographies. So that's the experience we wanted to bring to passive investors. And then we extended that model to other fund managers to offer. We built our own fund to do that. And then we extended that model for other fund managers to give that same experience. Okay. What this does, it combines the flexibility of deal by deal investing with the flexibility of a fund. I'll go into more details into that. You can raise capital 365 days a year. Even if you don't have a deal, you can raise capital with the understanding that the investor has a choice on which deal you want to put the money in. You can add any asset class in a fund. There are some limitations. For example, you cannot mix oil and gas with non-oil and gas. Oil and gas has benefits where you can offset against regular income. But pretty much almost any asset class, almost any real estate asset class, I think most of you here are, is it safe to say anybody in something other than real estate here? Everybody in, well, I know Akash invests in startups and things like that, but I would say the majority is in real estate, right? So you can mix all these real estate asset classes in the same fund. And the question which I often get asked is, what returns do I promise for my investor? What are the fund level returns? That's like me asking you, what's your stock portfolio return? What are you going to tell me? Are you buying an NVIDIA or are you buying an Intel? I mean, or whatever example you want, right? Depends on what stocks you're picking. So the fund return is a combination of all the individual deal returns. So there is no, each investor can build their own custom portfolio within the fund. And it's really just a conglomeration of all the individual deal returns. There is no notion of a fund level return, okay? And you have the flexibility to be a GP doing your own deals. When I say a GP, I mean a true GP. You're sourcing the deal like Akash sourced the deal here. Akash is one of our fund managers, so I encourage you to talk to him. He's been with us for more than a year. Has it been more than a year, Akash? Yeah, okay, good. And you can source your own deal, and you can be a co-GP where you're raising money with 2 or 3 others. I mean a true co-GP, not this pseudo co-GP business where people are becoming co-GPs where they're just raising money for others and calling themselves a co-GP. All they're doing is capital raising. Or you can be an LP. It's very clean. I'll let Chris chime in here. You're using the fund manager exemptions. There are various exemptions. We can talk about it. Chris can talk about it. So you get a preferred split. There is absolutely no reason you have to go after a deal we recommend. You can go negotiate with the sponsor. All we say is, hey, let us come and negotiate on behalf of all the other fund managers. If you don't want to do that too, that's fine. You go negotiate with the sponsor. You get that split, keep a portion of it, and pass the rest to the investors. So you can also charge a flat due diligence fee in the beginning, and then you can get a higher pref. Maybe you get a 9% pref and pass 8% to the investors. Maybe you get an 85-15 split, GP-LP split, and then you keep 15% and pass the rest to the investors. So I know I'm going a little fast. I want to pause here and make sure you understand why this is better than a blind fund. I have another slide which goes into more detail and why this is better than doing one syndication at a time. Actually, let me do the next slide and then I will pause. So what this does, it combines the best, and I'm happy to send a copy of this deck to Shamir and Chris, and they can forward it if anybody's interested. So it combines the best features of blind funds. When I say a blind fund, are you guys familiar with what I'm talking about? I mean, it's a fund where you don't have a choice. You're investing in every single deal in the fund. It's like a mutual fund. I mean, if you go to Fidelity and buy a Magellan fund, I mean, correct me if I'm wrong, I don't think you can go to Fidelity and say, I like this 20 stocks, but I don't like this 10 stocks. Remove those 10 stocks and give me the mutual fund. Good luck with that. You can't do that. See, the problem with a blind fund, I'll go into the problems in a second. This has only one set of legal docs. You can raise money continuously, and capital can stay in the fund even when there is no deal. And it also combines some of the best features of syndications. Like syndications, investors can pick and choose which deal they want. 100% of the depreciation benefits flow through like syndications. People invest in this for depreciation, right? I mean, that's one of the reasons. I mean, they want the tax benefits. And unlike traditional funds and syndications, there are some unique advantages. We have literally spent hundreds of thousands of dollars and tens of man years and developed this feature. Even if your investors invest in 10 different deals, they get a single K1. I get 40 K1s, not because of Avestor, just because of all the different startup investments and everything else. And I can tell you the only person happy getting that many K1s at tax time is your accountant. Who wants to get a bunch of tax documents, right? So we have automated this entire backend process where we subslice the K1s and recombine it, and you generate a single K1. And this model gives you amazing business flexibility, which is just not possible in a blind fund. Can you imagine going to somebody and saying that, I don't really know what asset class I'm investing in. I don't know what geography. Hey, but go ahead and just give me a check for $100,000. Don't worry about what deal I'm doing. Good luck with that. Well, maybe you can do that if you have an extraordinary track record, but then that limits you to a very well-defined business model. Here, you really can change your business model on the fly. I mean, maybe you do mostly multifamily, but you like self-storage somewhere. You can maybe go invest in that deal. And you're not kicking and dragging your investors, kicking and screaming into the deal because they didn't have a choice. Hey, look, I came to you for multifamily. I want to stick to that. I'm not interested in the self-storage deal. Yeah. And this is by far the lowest cost option for 4 reasons. We even have a calculator, but I may not go into that right now. But if you want to talk to me offline, then we can actually show you what cost savings you have. It's 1 ppm, 1 blue sky filing at the fund level, less accounting, less taxes, and less number of LLCs. So you can literally, even if you do 2 or 3 deals a year, you're saving anywhere from 40 to 70% in hard, quantifiable dollar cost savings, and quite a bit more in time savings. What's your time worth to you? So this is where I want to pause. I want to make sure you understand why a customizable fund is better than a blind fund, and why this is also better than doing one syndication deal at a time. Questions? Yeah, go ahead.
I want to make sure I understand, Badri. How does money flow? So when I put $1 million into Avestor,
Into not Avestor, your fund, just to be clear. We don't take your money. I'll tell you, why
so
don't I?
That's the question. How does the money flow? So
I'll show you the legal structure in a couple of minutes. So let me do that. I'll show you the legal structure. That might help answer your question. But basically, at a high level, before I completely bypass the question, I'll come back to the legal structure and I'll show it to you. What we working with Shamir and Chris is we'll create a fund LLC and a fund management LLC. I'll go into that legal structure in a second. And then the fund LLC will have a fund account and will invest in various deals. So once I show you the legal structure, it'll be clear. That's a good question, though. Maybe I should jump into it right now, but let's see what other questions are there. Other questions? Go ahead, Akash.
Just to clarify, you do not generate the K1s, you generate the data for the K1s.
That is true. Thank you. Thanks for the clarification. So we are not CTAs. So we generate the data for the single K1, but we do all the heavy lifting for generating the data. And then we work with third-party CPAs who have given us highly discounted rates, who actually file your fund tax return and take the data, validate it. And they validate their logic and computation. It's completely traceable. It's not like, oh, here is K1, trust us, we have calculated it properly. You can actually go back and see pro rata calculations.
So just to understand, so if I place my money with a fund manager, but I have access to deals that may come from other fund managers within the marketplace?
Only if you choose to do so.
If your fund manager chooses for you to do so, or you as the investor?
No, you as the fund manager saying that. So let's say Akash is doing a fund, and he's decided he's not decided, he actually has a property here. You guys just close the deal. And he's putting that as a deal in the fund. Then he likes a deal we have negotiated with a short-term rental, and this is not hypothetical, he actually does, and I think he's put that in the deal, a short-term rental fund. I'll show you the demo. Then he decided that he wants to expose the deal to his investors. You know, what I'm going to do is I'm going to digress a little bit and go ahead and actually show you the demo, because sometimes seeing the actual product will, and then we'll go into the legal structure before we.
But Shamir, I think
Sure.
to your point, right? So if you are the investor and you are my investor, then you will only see my deal.
I only see what you allow me to see.
Yes.
But you, as the GP, can open up other deals for me to see.
And no. So, hey, yeah, I think that Badri.
Yeah, I think once I do the demo, I think it'll be clear, except I need your help here, Chris. Sorry, I didn't realize.
If I, as a GP, subscribe to any of those deals, then you can
So you have to make a commitment to those deals to put 500K,
Yeah.
and then now you have 500K of
slice of that,
available for me, your LPs to invest in.
That is correct.
Okay.
because you don't want crossing. I don't want my
Oh,
investors coming
that's
in and
right.
leaving.
Yeah.
So they don't get any access to the website, right?
You have investor portal. Yeah,
Your investors are probably your biggest asset. I mean, we'll quickly go out of business if you start giving your investors to other fund managers.
Yeah, but if you could also talk about the regulation side of it.
Sure.
As a GP, if you're exposing a bunch of deals, shouldn't I be a GP in every deal for me to expose it to my?
That's where you take the fund manager exemption, and we'll talk about the exemptions, and I'm sure Chris will. I need this is not moving, so there it is. Yeah. Let me exit.
Most definitely,
Yeah.
exit this. But then you can't advise. So you have to have your fund like really like that.
Oh, in slideshow. All right. Can you guys see this? Okay.
I think they have a few funds which are RSSB, but most of the funds are RSSB.
So let's go through the demo, because sometimes it's just good to actually see it, right? I can talk until I'm blue in the face, but until you actually see it, yeah. And then we'll come back to all those questions. I mean, I will go back into the legal exemptions, and I'm sure Chris will add more too. So this is our own fund. This is our branding, but all of this branding is customizable by you. So it'll be your branding. We built our own fund to test out the platform. I will actually log into my own personal account. Some investments are doing well, some are not doing well. Hey, but that's true for all investments, right? So don't judge me on my investments, please. So basically, the idea here is to replicate the stock brokerage type of experience for real estate investment, for alternative investments. You'll kind of see the account balance there. You'll see the total earnings. This is a very powerful concept here. We have something called the virtual cash balance, which works like a stock brokerage account. For people operating stock brokerage account, they say, what's the big deal? I mean, I do that in my stock brokerage account, but you don't do that in your syndication deals. Today, when you have a syndication deal, what do you do with the money which comes in? Well, I hope you give the money back to the investors. Otherwise, you have another set of problems. We won't go there. So instead, what happens here is it goes into this virtual cash balance, which operates like a stock. If dividends come in, distributions come in, it goes into the virtual cash balance. Deal exits, goes into the virtual cash balance. And we have actually partnered with a fintech startup. I mean, you can do this without others, without that too. And they take that money, and if you decide to open an account with them, they funnel it into multiple FDIC insured banks, and you get $250 million worth of insurance, FDIC insurance, and they're giving 4.8% right now for money sitting in the account. So, I mean, obviously that depends on the Fed rates. It's not guaranteed forever, but it's tied to the Fed rate, yeah. So what the point of the virtual cash balance, I mean, that's a slight digression. You can open your fund bank account with whichever bank you choose. That's not a problem. The point I was trying to make with this virtual cash balance is it is very, very easy for you to go back to the investor and say, hey, you have $20,000 sitting in Joe, you have $20,000 sitting in your account. Do you want to invest in another deal which I'm coming up in 3 weeks? Yeah. I can speak from experience. I actually ran investor relations for our fund before. We have closed it now for new investors, because the whole point of it was to test out the platform. Less than 3% of the money gets withdrawn. People just keep reinvesting. It's not that our deals are that phenomenal. It's just, lethargy. Oh, you have another deal? Great. I'll just invest in your new deal. So it completely transforms the relationship you have. This is an account snapshot. Actual deals I've invested in. Intentionally, the amount invested in each deal is a little shorter. And then right here, you can build custom portfolios tailored towards each investor. You can replicate the stock bond type of experience. You can put debt in the same fund. You can put equity in the same fund. You can do different asset classes. Maybe you have a client who has a kid going to college in 5 years. Maybe they like debt. Maybe they like preferred equity. So you can build custom portfolios which completely transforms the relationship you have with your investor. Guaranteed. I will come and invest in your next deal, but I can tell you there is a very, very high likelihood they'll come and at least talk to you before they invest in somebody else. Because now you're taking a holistic approach as opposed to selling them one deal at a time, yeah? This is a portfolio liquidity graph, which tells you approximately when you'll get your money back. You guys are in real estate, or hope to be. No guarantees, it's just a projection. And these are actual deals I've invested in. I don't know what you want to call it a vanity map, if you will. Let me click on, I don't know, some random deal here. This is some hotel to multifamily deal in Scottsdale, Arizona. You get the idea. And just like a stock brokerage account, you'll be able to go and see how each individual investment is doing. So this shows you how much money you have invested in each deal, intentionally smaller slices. We were testing the scalability of the system. And how much money you have made. You can click on anything to get additional information. This is where you upload any underlying PPMs if you're investing in somebody else's deal. But if you're doing your own deals, we have something called a deal disclosure document. We'll talk a little bit about that. You provide any project updates, and it's just like other portal, but it gives you a consolidated view of your portfolio. And then if you want to invest in a deal, going back to the question Shamir was asking, these are the deals which you have chosen to expose to your investor. It could be your own deal. Maybe you stick to only your own deals. You don't want to raise money for others. That's fine. But here is an example of a deal we have negotiated. For example, ex-Apple Facebook employees called a Techvestor short-term rental fund. They have built a high quality short-term rental fund across the US. And we have negotiated, this is one of their actual properties in Scottsdale. And we have negotiated a 90-10 split for, even if you raise $10,000, you're going to get a 90-10 split. You can keep 20% and pass 70-30 to your investors. And here is the best part. That is still better than what they would get if they go to the sponsor directly. Again, purely optional. You want to come in and say, hey, I'm not interested in raising for others. I'm just interested in my own deal. No problem. And then if you're interested, you can just do a soft commit. You guys are probably familiar with that concept. I mean, where the investor is saying, I'm interested in putting $10,000. And you can convert that soft commit into a hard commit just by a click of a button. Say if the investor already has $10,000 sitting in this account, then you can say, okay, we are just going to transfer that to the deal. So does that answer your question? So you have complete control on what you're actually exposing to your investors. So we'll come back to the legal exemptions, and we'll also talk about where the money, how the money flows. But other questions at a high level, or shall we go ahead and go into the legal structures a little bit?
Is there any sort of minimums or maximums you can?
That's completely up to you. It's your fund. Yes, of course, we have a minimum, and we have a, well, does anyone have a maximum? I guess you could have a maximum. I mean, if they want to take the whole deal, well, there are other problems with taking the whole deal, but yeah.
So what's the minimum deal you're starting with? 100K, 500K?
It's completely up to you. You can even, we have people raising money for as little as $100,000 deal. Can you imagine paying an attorney $15,000 for a $100,000 deal? The math doesn't work out. You know, there is some problem there. You can set a fund level minimum, and then you can set a deal level minimum. You can say it's $100,000 to get into the fund, 50,000, 25,000. We have everything. It's just like opening an account with a stock brokerage. And then for each deal, you can say $10,000. We set a very low minimum to start with, 2,500. I'm not recommending you do that. That was just, we wanted the hundreds of transactions. And in fact, for our debt deal, our minimum was $500. Again, don't recommend you do that, but we wanted millions of transactions to test out the platform. Yeah. Shamir, you have a question? No. Okay.
But you're showing the investor side of Avestor.
I'm showing the investor side. Normally, we don't show the sponsor side in a public setting because there's a lot of secret sauce behind it. But you can imagine, right? You can create a deal. You can allocate slices. You can, an investor comes in, you can onboard an investor. And let me go back. Let me finish that presentation, and then we'll go back to this. So in terms of the benefits for capital raisers, when I say capital raisers, don't think of capital raisers as raising for others. I mean, even if it's your own deal, you have to raise capital, right? If you have enough money to do the entire deal on your own, well, then we can't help you. I mean, you don't need us, right? I mean, but most people want to raise money from others too, as the deals get larger. So the main advantages are you can raise capital at any time. You have a very adaptable business model. I'm just recapping. Highly simplified operations, a lot of cost savings, and then you reinvest investor earnings. You have that ability to do that. Maybe not in that same deal, but maybe in a new deal. You can almost have people putting in, I want to put $10,000 a month into this platform, just like a how you do in a stock brokerage account. Sometimes you say, I want to put $1,000 in this index fund every month or something like that. Yeah. And then from the investor perspective, they have complete control over the investments. I mean, they are controlling where they're putting their money. You're getting a level of transparency which you will never get in a blind fund. And you have a single set of legal docs, single K1. We already talked about that, right? So this is the training program I was talking about. 10-week training program. It talks about how you create a winning capital raising strategy, creating a winning pitch deck. We give you pitch deck templates, formulate a go-to-market plan. You might say, oh, I know I've done all this. But even people who have raised tens of millions of dollars have benefited from this program. And we have, there is this entire messaging framework which is developed called the Capital Raise Framework. A lot of people have really loved it. And there's bi-weekly coaching calls and office hours. It's included. If you don't want to use it, you don't have to. So the main point I want to stress, how are we doing on time? I think we are fine. Is everything you need for your investors is integrated into the portal. We don't want your investors or you to go to multiple places. You can if you want. The ACH is integrated, unlimited ACH capability. There is a limit of $100,000 per transaction, but you can do multiple transactions. Electronic document signing. So all the documents are uploaded and you can sign electronically. Anti-money laundering and know your customer checks are integrated. Now, some of you might say, I don't need it, but you don't need it until you need it. I mean, you really want to know. It doesn't happen very often, but you really want to know if somebody is on a watch list. I mean, there is just a lot of regulation in this space. Accreditation checks are integrated. So if you do a 506c fund, we'll talk about the different exemptions. Then we are using a third-party provider, but the investor doesn't leave the portal. It's all one common experience, yeah? And then here is something a little geeky. We are the only platform in the world which will allow you to backfill your capital. Let me explain what that means. I have to become a little geeky here, but let me explain what that means. Let's say you're raising $1 million. Stuff happens. You're 100K short. I mean, sometimes the raise doesn't go as you predict. You put your own money in. Other platforms give you a portion of the cash distributions while your money is invested. We do that too. But we actually calculate the time value of money, and we give you a portion of the money in the back end. So for example, let's say it's a 5-year deal and $100,000 was tied up for 1 year, you get 20% of the back end. So what this allows you to do is have always a ready stream of inventory. And it's like somebody coming in and saying, I hope you trust your deal to put your money in for at least a year, otherwise you have other problems. And then you always have these slices which are available to investors to come in and say, hey, I'll take a slice of that, yeah? So we offer free fund level bookkeeping, not filing the tax return. That's where we work with other third-party CPA providers. And then we have some deep investigative software for background checks, Thomson Reuters, the same kind used by police and FBI departments. You don't want to run that for every investor, but if you want to partner with somebody, people have done it and they've decided not to partner. Something comes up, right? It's one of the deepest checks in the industry. It's just part of the service. And the list of services go on and on. We give a free copy of Go High Level CRM, Customer Relationship Management. We help you with automation, funnel, and website templates. We give you marketing collateral. We give you discounted D&O insurance. We give you a discounted copy of Zoom licenses. Today, if you want to do webinars, you have to get the webinar version of Zoom, which costs about, I think, not less than $80, $80 or $90. We give it to you for $20. Our value proposition is like I don't know if there's a great analogy, like the Costco model. We negotiate really preferred terms and we pass all those savings on to you, yeah? So we'll come back into the pricing model in a second, but let me go ahead and get into the legal discussion, which I've been saying I will. Legal structures. Okay. Older version. All right. So what is the fund of fund structure? I think I have a later version, but this is good enough. So you're creating a fund entity and you're creating a fund management entity. It is very important that you do not manage the fund directly for liability reasons. Chris can talk a lot more about it. So we create a fund LLC and a fund management LLC. That fund entity can invest in an asset, it can invest in a syndication, or it can invest in another fund. So you can invest in another blind fund if you want. I mean, the fund of funds, we have several funds who are investing in multi-billion-dollar blind funds. So I think Akash does that, where the minimum investment is $500,000 or $200,000, and he slices it and gives a $20,000 investment, just to give an example, yeah. So when you create this customizable fund, working with partners like Chris and Shamir, we create the fund LLC. We recommend Delaware, but I know there was discussion of Wyoming and all that, but we generally prefer Delaware for various reasons. We create the fund management LLC. They create the LLC docs, the PPM, the operating agreement, the subscription agreement, SEC filing for the fund offering, and custom operating agreement for your fund management LLC. So going back to your question, where the money flows, Mr. Purple comes in here and he invests in the fund LLC. You have investment one, investment two. So the fund LLC will maybe make a $500,000 investment in investment one, maybe $1 million investment in investment two. Mr. Purple may come in and say, I want to put 30,000 in this deal, 20,000 in this deal, and we dynamically recalculate what percentage of the LLC they own. So they have direct lien things which can be traced to the ownership of these two investments. That's how it works. So the fund LLC has a bank account. They put their money in the fund bank account. It's a common bank account, just like in your stock brokerage accounts, right? I mean, all of that is in a common. It's not really kept in a separate bank account. It's in a pooled bank account, but you keep track of how much is in each investor's account. I don't know if this helps. Does that answer your question? So, one caveat though, if you are creating your own asset, which like Akash did, where you're buying your own asset, we definitely do recommend creating an asset LLC for additional protection. You don't want to mix it with all the other funds. The fund owns 100% or 50% of the asset. You can do two JVs between two funds. Any distributions from the asset LLC goes to the fund LLC and then gets distributed to the investors. So in terms of exemptions, do you want to talk about that, Chris? I mean, the fund manager exemption, the 3C1 versus 3C5, or do you want me to talk about it? It's up to you.
It would be about a 2-hour discussion, so.
Okay. Let me try to reduce it to a 2-minute discussion, and obviously I won't be doing justice to it. So there are two exemptions you can take as a fund manager. There's lots of exemptions, 3C7 for oil and gas. I mean, there's a variety of ones. But the 3C1 exemption allows you to invest your money in other people's deals and take a slice of it without having to become an investment advisor. Now, again, there are some states where you may have to become an exempt reporting advisor. We'll get into the details. Chris can advise you on all of that. But that's very different from becoming a registered investment advisor. And the limitation of the 3C1 fund is that 80%, you can have only 99 investors, but 80% of the fund's money should be in real estate you control, where you have voting rights and you have the ability to maybe fire the property manager. Or you can do a 3C5 fund. It does not have the 99 investor limitation. And it's a little less regulated, but that's a kind of a replacement for syndication deals, where you're actually doing your own deals. So if you want to do both, you have to do 3C1. So the last thing I need to do is talk about the fee structure, if you'd like to know. But before I go there, other questions? There's a lot more we can talk about exemptions. But
Yeah, we can, if there's specific questions towards the end, I'll answer
Yeah.
them, but there's a lot of specifics.
The one other thing I want to mention, you can do a 506B fund or a 506C fund. A 506C fund can invest only in 506C deals, and you can advertise, but you can take only accredited investors. A 506B fund can invest in 506C deals also once it's $5 million in assets. Again, Chris can work with you on all of that, educate you. And we have a ton of educational content also, which talks about all of that. So, Akash, go ahead.
No, I think you answered the question. I think he was asking about 506B funds.
Okay.
Sitting at $5 million to make the fund accredited.
Yeah, the fund entity itself becomes accredited, but you still cannot advertise the fund.
Correct.
Yeah.
I'm curious, this might be a complicated legal question, how you can issue 1K1 if you're invested in a panoply of funds.
So what we do is we basically trace the lineage and let's say this fund has invested $1 million in a deal and one investor has put 100,000. So we take the K1 which comes in from the deal and then slice it. And so you get 10% of that K1 and then we recombine all of that. You can do that manually, but I think he can attest to it's far better to do it in software. So he's a CPA, so.
Do you do the same thing with state K1s? Because you've got the same issue. I'm assuming you're talking about federal.
We're talking about federal. So the state K1, we don't generate separate K1s. I mean, you will have to, the CPA, you as will have to advise them. Has there been enough money generated? And the individual has to talk to their tax consultant to see if they have to file the fund tax return with them.
Has anyone ever been audited, had to prove, track that K1 to the multiple K1?
Not so far, but we have complete traceability. I mean, we have worked with the top 20 accounting companies. Before they agreed to work with us, they put us through the ringer. I mean, they went through each transaction. They looked at a sample thing, and they saw every step in the process. It's all generated. Reports are there. Every penny. My partner doesn't sleep at night, even if you're off by 1 penny. I said, it's a penny, but Sanjay, Sanjay. So.
I would assume all the K1s are just going into that fund LLC, and it reports all the K1s and just distributes it, especially to each investor.
Exactly.
Yeah.
Well, you do. I mean, as a partner, as the CPA partner. So. Feedback. Does this make sense? Especially people who have done syndication deals. I mean, do you feel it addresses your pain point?
Having just gone through tax season.
So I see most of the people who comes to me who work in IT. And once they're done with the 3 years of their employment, they get the maturity of their 401k. They'll ask, do you have any option that I can come into real estate? But I still work with my current employer. They want to transfer the 401k to any real estate or any.
If the current employer allows them to transfer the 401k into a self-directed IRA, then yes. I don't have any magic where I can go to the current employer and say you should transfer. But most employers don't allow you to transfer your 401k until you leave. But we work with all the self-directed IRA providers, and we can work with all the major ones. And if you have somebody we can work with. But I don't have a solution to, hey, I'm still working in my company, but I cannot invest in real estate. Akash, right?
No, if you recently changed jobs, then obviously all that money that was sitting in your 401k can be turned into a self-directed IRA.
Yeah.
And then all the fund managers can typically work with SDIRAs.
On the K1s with the SDRA, the UBIT and all of those complications that come in, is that all handled or addressed? Yes.
It is. UBIT is always a thorny issue. Yeah. So we recommend investing in deals where there is no UBIT. To be completely honest, my partner deals with the thorny issues associated there. So
you can do a self-directed 401k instead of a self-directed IRA.
Okay.
So you do a self-directed 401k,
yeah,
but there's no UBIT.
Well, yeah, there's a bit of be investors coming in, right? So it's hard to tell them to change that.
So let me ask you a question.
Sure.
If as a GP, if I have the ability to source my own deals and fund it all individually, you're saying then it's pretty much, there's not a whole lot of value I can get from this.
No, not at all. If as a GP, you're doing a separate PPM for each deal. You're doing separate.
I have a fund. No, we have a fund too, and I have multiple deals, but everything is under the fund.
Yeah. Then the question is, if your investors are happy with the blind fund, that's fine. But I think you'll find that you'll get exposed to a much broader class of investors who get the benefits of the fund and they still have the ability to pick and choose deals. But if you are comfortable with a blind fund, I mean, that's the trade-off.
That ability we don't have. The investor doesn't have the option to pick and choose.
Exactly. So that exposes you to a much, much broader class of investors, in our experience. But if your investor is already comfortable, and the other thing which allows you to do is, your fund needs to have we already talked about that, a very well-defined thesis. Let's say you want to experiment with a new asset class. You can't do that in your blind fund, but you can here. And your investors are your biggest asset. Why not leverage them? Not leverage them, that sounds negative. Why not give them additional service of other asset classes?
How do you get this? Suppose if I have to make sure I want to invest as a fund of fund, another fund, I want to make sure that investor reporting is, basically we're meeting all the standard criteria.
Yeah, absolutely.
So how do you guys vet it before they can come into your ecosystem?
So I want to be clear that you by no means have to go with only the deals which we recommend. So we do some preliminary vetting with the top tier operators. For example, many of you are familiar with Rice 48. They're one of the operators who come to us and have given us preferred terms. And in fact, Zach sent me an email, and I think he may be presenting next week in our mastermind. So we do some preliminary vetting. At the end of the day, you as the fund manager are responsible for vetting the deal and ensuring that we can run a background check for you, but that is your job, I mean, as a fund of funds manager. And if you don't want to invest in other people's deals, that's fine, just stick to your own deals. But to answer your question, if you have a blind fund and the investors are comfortable with investing in a blind fund, and you have no desire to invest in other people's deals, and you have no desire to invest in other asset classes, things are hunky-dory, you don't need us. So.
Well, see, again, the other thing is, right, so you can put your own deals on the platform, and you can bring other people's deals on the platform as well. You don't have to necessarily go with what Avestor brings in.
Yeah, absolutely.
You're earning a promote on other people's deals just by putting them on your platform.
Exactly. And so, like, in my fund, I have.
Hey, Akash, actually, why don't you come up and speak on your fund? For a couple of minutes, no, come on over. And then we'll do pricing and conclude. It'll be good. This is a real customer, and I'm not paying him anything.
For us, for y'all, the value is like the funds you guys have right now are currently set up as blind pool funds, and we're limited in terms of multi and complete asset classes. Their position is the value is in the investors. So if we can take that group of investors, expose them to more deals, ideally your AUM increases because you've now expanded the scope of the deals that you did there overseas.
That makes sense.
So like on my fund, right, I have four different deals on my fund. One of them is my own deal that I'm sponsoring, which is a multifamily deal here in Dallas. The second is I'm a part of raising short-term rental for what Badri was talking about for Avestor. Third is I have an ATM fund deal where we invest in an ATM fund. And fourth is I'm raising money for startups in India, right? So totally different asset classes. Now, if an investor comes to me and says, hey, I have $200,000, I want to put some of this money to work, and you send me your multifamily deal, I want to put some money in there. I'm like, okay, sure. But when they log into my portal, they see 4 deals. And all of a sudden they may be, hey, can I put $50,000 in India fund? Sure, why not? So now you're basically giving them a diversified basket of opportunities, if you may, to invest in. And you get that investor, you're basically not losing them to somebody else. That's what my philosophy is, that you can put as many deals on this as possible.
I have a question. So on a multi-deal, for example, where we have a hard funding date, right? So we have a multi-deal, it's going to close on May 15th. I've got multiple fund managers that have committed. Akash has committed $1 million, you should have $500K. What if they've committed their money, but what if they can't raise by the deadline that I've set? Is that the backfill component you guys have?
As long as you have enough money to put your own money in.
Okay.
We don't generate money. I wish I could. Then I wouldn't be in this. I mean, I would be in buying an island somewhere.
You can shift around.
You can shift around. Yeah.
So Shamir, the example for that would be, right, hey, so we are closing on Tuesday.
Yeah.
And for the close, we need about $2.9 million.
Are you there?
So we have
No, I'm just kidding.
we have 2.7 in the bank.
Okay.
Okay. We have 2.7 in the bank. We showed $200,000. I'm putting in $200,000 in there. I had already put in $250, so I'm now putting 200 more to close the deal. Now we continue to raise after the deal is closed, and if you're able to raise, I think that I put that investor money in and I take my money out.
Okay.
And he's getting paid not only the cash distributions. Even if he's there for 20 days, he'll get 20 days worth of capital gains at the back end.
Okay. Oh, so it's prorating the capital gain on a
Also,
per-day basis.
which is we are the only platform in the world which does that. We are a little proud of it. Sorry, but yeah. So.
And you're chopping up the K1 as well, so he's getting a 20-day K1 for his duration.
Correct.
Okay.
And all that's part of your fund disclosure?
Yeah.
So what about Blue Sky? So, as investors are coming in, what is it? Is it 50?
So,
because there's no real closing of the fund. So there's normally a.
They have technology that keeps track of that. We've talked about that on the legal side. Go ahead.
Yeah. Normally, the Blue Sky is done by the legal team, but we do that.
Okay.
So we have this entire compliance dashboard. Notification pops up. We'll send you an email saying, "Hey, you need to file a Blue Sky filing. Would you like us to do it for you?"
Okay.
Now, you could say no, but I don't know why you would do that. And we charge $50 plus the cost of filing. Trust me, $50 is a bargain.
So when does that happen? When someone makes an investment?
Exactly,
in a fund.
exactly. So we do it in real time. I mean,
Yeah.
you don't want to
Yes.
file in all 50 states with the hope that you'll get an investor from.
Yeah.
But the key thing here is the blue sky filing is done once at the fund level, not for each deal. Today, if you do
So
4
just adding
deals well, in a blind fund, I guess you're okay. If you do 4 deals and you have 10 states, that's 40 blue sky filings.
Yeah, but if you've already filed them.
You already filed. Yeah, and some blue sky filings you have to do annually. I think Chris may say, is that about 10 or 15 states where you have to do annually? Handful, yeah. So that doesn't change. I mean, you still have to do it annually. So he's had experience. I mean, go ahead and ask him a fund manager's experience. I mean, I'll close my ears. I don't know.
On the Techvestor side, so on that one where it's not your fund, you're essentially, you're a fund of funds investing in that fund, right?
That is correct.
So how is that disclosed to investors? Do investors know what deal you're getting and what your spread is?
So can I?
Yep, go ahead.
Sorry, I know you. What we have is something called a deal disclosure document. Unlike a 50, 60 page BPM, it's a 8 or 9 page deal disclosure document. It's a template. We do recommend you get it reviewed by the attorneys if you like, but that discloses the splits. We are very, very conservative, over disclose. Any conflict of interest you should disclose in that, risk factors. And we have worked with a dozen SEC attorneys in developing the deal disclosure document, which has evolved over the last 3 years. And the investor does sign the deal disclosure document. So the fact of the matter is 80% of the BPM is the same. I mean, 70%, whatever it is, right? So we take that remaining portion and put it in a deal disclosure document.
So you sign 1 ppm, but at every deal level, there's a deal disclosure where we disclose what fees that we are taking on that particular deal. Like, for example, on the Techvestor side, if you as a retail investor go to Techvestor, they will give you a 50-50 waterfall split. But, because now Avestor has negotiated with Techvestor on a 90-10 split, I, as a fund manager, can do a 70-30 with my investors. So I'm still keeping the 20%, but the investor is getting 70% instead of the 50%. So I'm still giving them a better return than if they went directly to Techvestor. So that's the bargain there.
How do your investors like the platform?
So I've recently had about 30 investors invest in my deal. And, if you're doing it on a phone, it may be a little bit clunky because, you can't see a lot of things. But if you're doing it on a computer, it works great. And even on the phone, they can do about 90% of the things. But one of the things is, you have to, if you really want to read the PPM and all that, it's not going to be, but this is the product from the perspective of you actually, when you sign up, you actually just go through uploading your driver's license, then creating your bank account information, pulling in your investor account information. All of the PPMs can be signed up there. So I think it's fairly, and not only that, accreditation letter from a third party, it generally comes back within 12 hours. Generally, pretty easy to work with. I have had, I have not tried the ACH yet because I want to make sure that that money comes into the bank account right away. So I generally give my investors writing instructions, but ACH is it supposedly works, I guess. But,
we have a lot of money coming.
But sometimes ACH is on a schedule, so it may take 3 to 5 days.
ACH takes longer.
3 to 5 days, and I don't want to be in a limbo. Where the investor says, "I send the money," I'm like, "Okay, I'm still waiting for it. I don't see it." So far, so good.
What, I guess, on your end, is there so from a longer term perspective, do y'all intend to create almost like a marketplace of deals eventually?
Okay,
where
so
fund managers can then pick and choose?
Not quite a marketplace of deals, but a marketplace of funds. We already have a marketplace of funds, but your investor is not going to see that marketplace.
Right,
I mean, they have to go to Avestor, they have to look at the website. If you go to our website, I won't go right now, you can see a marketplace of funds, and Rakesh is listed in one of them. Okay. Obviously, we cannot list 506B funds. And we have a marketplace of funds, and people have got some investors from the marketplace. We have not even spent any advertising dollars on that. We do plan to funnel some investors' money into that. That's another bonus. But I don't want to mention that until we have something to offer you. But people have already got some investors from the marketplace.
See, even the investor portal login that Badri was showing you, it can be customized. So, if you go to my investor portal, the look and feel, like the pictures and my logo and all that kind of stuff. So that look and feel is different.
Completely customizable, yeah. One last thing. So thank you, Akash. I appreciate that. So it costs roughly about $18,500 plus filing fees to create this evergreen fund. I don't know which attorney you work with, but that's not a lot more than what you pay for one syndication deal. That $18,500 is split actually into two parts. $8,500 goes to us, and then $10,000 goes to the legal team, plus filing fees. The filing fees includes the registered agent fee, creating the fund LLC and the fund management LLC and all that. I'm not going to talk too much about the starter plan because that's not applicable to most people. That's limited only to $5 million. And it is also only one fund manager, and it's a standard PPM. You cannot upgrade or anything like that. So far, not a single person has signed up for the starter plan because it's fairly limiting. Most people start with the scalable plan, which is it's the $18,500 plus filing fees. That's a one-time fee, and it's $600 per month for the first 1.5 million. Yeah. And anything above the 1.5 million is 40 basis points, 0.4% annually, billed monthly, divided by 12. Or there are several people, for example, last month we had more people sign up for the pro plan than the scalable plan. It's $1,500 per month for the first 5 million. And then each additional 5 million is $500. So that the incremental AUM fee is not AUM, EUM, equity under management, not assets under management, is less than 12 basis points. But again, I won't get into it right now, but even if you do 2 or 3 deals a year, if you're doing separate syndication deals, you're actually saving money in this. For 4 reasons, like 1 PPM, 1 blue sky filing, less accounting, less taxes, and less number of LLCs. And this includes everything, the fund bookkeeping, it includes the training, the 2-day course in Portland. There's a whole list of features. So,
An investor portal alone. So
the investor portal, the backend portal. So what I showed you was the investor portal. That's the tip of the iceberg. The backend portal is, where the K1s are generated, you onboard the investors. That's where 80% of our effort was spent developing. So that's the basic pitch. So we think that it's a game changer as far as capital raising is concerned. What I can do is let me put up my contact information, but I'll also have some cards for you here if you want. If you want more details, just reach out to me, email me, LinkedIn, whatever. And you want a demo, I can do it myself, or I have one of the members of my sales team can do a demo. We can get a fund launched in as little as 3 weeks. If you're 4 to 5 weeks, but as little as 3 weeks, depends on various factors on how fast you move. And once you launch a fund, adding a deal you can do it in an hour. So it's really the first fund which takes a certain amount of time. We have already worked with Chris and Shamir. They've done a great job. We want to make them one of our preferred attorneys moving forward. Have you done 3, 4, or at least
4, I think.
4? We have several more headed your way. So
yeah, it's very easy. Good people to work with.
Other questions? Maybe we have a little time for a few more minutes of circulation and some more cookies or.
So a bit of a, I guess, tough sort of off subject, can't predict the future. Like this is quite a complex fund, which obviously gets it's all based around the platform, right? The platform makes this easy to manage,
Sure.
easy things. And kind of a business question, like what is the longevity of Avestor. You know,
Sure,
this-
that's a fair question. It's a
not-
very
it's not
reasonable
that,
question.
You know, disappears, it's like, oh, shit.
Yeah. So the fact of the matter is, every transaction can be exported. We can export all that into Excel sheets. But I would be misleading you if I say that, you can create any number of deals if we go out of business. By the way, we are solidly profitable, rapidly growing, but hey, stuff happens, right?
Yeah.
And so you can definitely let the fund stop down. I mean, don't add more deals. You can add more deals, but then you have to do everything manually.
Yeah.
But at least you can let, whatever deals you have, you can let it die down and distribute it. You can do it with Excel sheets. You'll have to work with the CPA. The CPA bill will probably be a bit higher. But we have a transition path where at least all the data is exportable, every element, everything.
Perfect, yeah, as long as you can get it all out.
Yeah.
All the bookkeeping is in QuickBooks.
Okay,
Yeah, and it's your account. The QuickBooks is your account.
all right.
So yeah, all the bookkeeping is in QuickBooks, all the transactions, the K1 data, everything can be exported.
Yeah, many years ago, man, started Avestor, got an Avestor portal, went with the group that then this cloud.
Yeah.
That was in the early days, and just transitioning from one portal to the other, that deal was.
Exactly. And we have spent a lot of time. Sometimes we get an initial reaction, you guys are too expensive, I'll be honest, but what we are offering is a completely differentiated service. And we have built a model where it's sustainable in the long term. I mean, we have a 20% development team. I mean, enterprise software is not easy to develop. So. Thank you very much. I'll be around. Appreciate your time. So I will have my cards here if I can figure out where they are.